Live from New York City, it's the Dream Shakers podcast. I'm your host, Stefan Odom, here with my co host,
George Nunez.
and we are back with episode 31. Today's special guests are Stanley Glover and Chris Rumper, the co founders of Throne Capital and the Pockets Property app, a brand new startup that recently set Reddit ablaze as it aims to revolutionize real estate investing through fractional ownership. We're glad to have you both here with us today, and welcome to the pod.
Thank you. Glad to be here.
Yeah, we're excited to be here.
How are you guys feeling, man? We've spoke on a number of occasions, and it's just great to finally have you guys on the pod. Like, what was going through each of you guys' minds?
Man, it's one of those. I know how you just asked how we're feeling. I guess my answer would be dangerous. We're just cruising on down the road. Making a boatload of progress. Getting things done is in a quick and concise manner. So we're feeling good. We're feeling good. Team's firing on all cylinders, and that's all you can ask for.
Yeah, no, right along with Stan. I think feeling dangerous is the right term. I think we're feeling good, like, because when we look at our company, we're scrappy. We're bootstrapped. We don't have funding like these other fractional real estate apps, where we don't have traditional means of funding yet. But we've done these things like secured massive lines of credit for property acquisitions, secured banking partnerships. These things that all of these other competitors haven't quite done, but we've been able to do, and get to darn near like 2 to 3 times the traction with none of the capital. So we're doing we're feeling great. We're excited, and we're eager for launch.
Now, this is amazing, right? Dangerous, scrappy, and giving it a in-depth, look into what Pocket Properties is. But we have to take it to the humble beginnings. We have to take it back here. What was it growing up in the South Side of Richmond, Virginia, for the both of you guys?
Got you. Yeah. Man, I've been around, hustling, making money from the beginning. Really humble beginnings. Started out fixing up and selling trailers. Just little 4x8 trailers. Making $200 a pop or $150 or whatever. Just learning that you can make money through non-traditional means. A lot of people focus on, their current situation. Hey, I don't, have the most amount of money. Well, you can get the money. It's not that hard once you learn and take opportunities to be able to do that, even on a super small scale like that.
Yes, I grew up. Yeah, honestly, it's funny because I think Stan and I's homes aren't too far away from each other. But yeah, grew up in basically south side of Richmond, North Chesterfield. But yeah, I'd say definitely a middle class family. But I mean, when you're middle class and Black, it's a different type of thing. It's not the same thing as your white counterparts. Especially being a kid who my parents, they sent me to private school, but not necessarily could afford it. So being a kid, you understand the back end of what these things cost, and you understand you have you grow up with a very solid understanding of we got to keep the lights on, we got to of bills being a thing. So I'd actually started my first business when I was 8, is selling tech decks. So if you're familiar with the tech decks, the little skateboards. So I had that business for 2 weeks. They shut me down at camp because I was making too much money. Some of the kids were going home, and their parents were none too pleased that they did not have the money that they sent them to camp with, but they had these customized skateboards that I had sold them instead.
They don't want to see you win, brother. They don't want to see you win.
Exactly. No, it's funny because the camp counselor that shut me down, he was a brother. He was excited. He was like, "Man, you're doing well, but you're making too much noise right now. You gotta chill out." And then a few days later, he ended up shutting me down. He was like, "Dude, we gotta shut it down. Props to you." But yeah, carried a lot of that entrepreneurial experience throughout my life, doing a few different, started another skateboard company growing up, and then a few other different companies as a kid. But then I talked a little bit earlier about, my main professional experience being once I left college. But yeah, that's just a little bit about our backgrounds.
So that provides some of the color about the initial beginnings. What then spurred the interest in real estate?
Gotcha. Yeah, that was kind of an interesting kind of shift. So Chris and I want to say 2017, after we actually met. To give a little bit of background how Chris and I met. We met doing door-to-door sales. Chris hired me. I got to the job, did not know it was door-to-door sales until I was out there knocking on people's doors. They're very good with their marketing. But fortunately, I met Chris. We hit it off. Once I left there, we ended up getting into music distribution, digital music distribution, and artist management. Once again, Spotify, iTunes allow free distribution. About 6 months after we started that, you can't compete with free. And plus, artists don't have a lot of money, especially new ones in Richmond. So we ended up shifting. I went off to William and Mary. Chris calls me. He's like, "Hey, we should get into real estate." I'm like, "What? Excuse my language. What the hell are you talking about?" So he's like, "We could do real estate syndication." I was like, "That sounds complicated and stupid." He was like, "How about we kept looking. Ended up finding a guy who was putting up bandit signs, those signs of like, we buy ugly houses." And Chris called one of them. He's like, "Dude, you got to meet him." And he taught us the ropes of what's called wholesaling, which is a great way to invest in real estate without having to put money down, essentially middlemaning properties, writing up deals for people with the money, and then selling them that property, and you make money on a spread. But that's how we ended up getting into real estate. We did that for about two years, Chris, right?
About 2 years.
And that kind of, that evolved. We saw a lot of the barriers that people were facing in real estate. We were buying, people's flips that had, they couldn't handle it. People that got over leveraged, that type of stuff. So we saw a lot of issues within the real estate space. And that's what really ended up evolving and kind of, becoming Pocket Properties and our main value proposition and the main issues that we're trying to solve.
Yeah, and then we ended up launching Pocket Properties in January of this year.
Yeah.
And it's been traction ever since.
We see the traction. We see the rave about Pocket Properties app because I seen someone actually post you guys, and that's when I knew, all right, like these guys are somebody. I mean, you guys have been on my radar for a while, and I was kind of hesitant to reach out, but then I seen somebody, reposted. I'm like, all right, cool. Let's see if there's a connection there. Let's get into competitors. What makes Pocket Property, just for the clear understanding of the audience, what makes you guys stand out from competitors like a Fundrise?
So from a Fundrise, I think specifically in the way we want to kind of position this one, because Fundrise is the big name in fractional real estate right now, right? But Fundrise is what I would compare to more like a Vanguard. So, you're going to give them your money, but you're not going to see that money for a while. I mean, you can look at it, you're not taking it out for a while. They're going to have control over it. They're going to get you good returns. And you can trust that you're going to see those returns, but you're not going to have access to your money. Now, what we're creating is more of the actual New York Stock Exchange, but combined, because we're creating the industry, we are going to be the listing house and the brokerage. So essentially what we're looking to provide and what's going to separate us from, Fundrise, is we're going to be offering, like we said, we're going to be rolling out with our banking services. So we're going to be having, debit issuance, account issuance, credit issuance, things like that. Then we're also going to be offering instant lending, which is something that traditional banks currently don't offer for the most part. I don't believe. Now, after that, we're also going to be rolling out the fractional real estate. And then from there, we have several value adds, such as international property investing. And then we're going to also offer different slates of commercial properties as well. But they're going to have access to investing in those individual properties, very similar to how they would a stock. So they have control over the actual property versus investing into a fund or a portfolio. There's a lot of different ways.
And real quick, Steph, could you break down to the audience what fractional real estate is, just so that people could understand as well?
Yeah, absolutely. So fractional real estate in its simplest terms is, as it sounds, it's real estate. A real estate asset has been broken up into shares. It's very similar to a stock or a standard security. A standard security is just a company broken down into shares. You might get a dividend, which is some of their revenue or their profit or whatever model they follow. Same thing for real estate assets. That you own a share of a property, you'll get a dividend payout based on your ownership in that property for that particular share.
And earlier on, Chris, you had mentioned that there was some clearances that you needed to obtain. There were some boxes that you needed to check off. This was things that you had done prior to even beginning to build capital or gather capital. So how is it working through the regulation process with the SEC? And both of you can feel free to chime in here.
Yeah, I was going to say, Stan, did you want to? I think Stan's going to have a lot more to say. I would say it's not been. I mean, it hasn't been as difficult as we thought. But it definitely, it's not an enjoyable process.
It is not an enjoyable process. Fortunately enough, my background's in government and legislation and policy. So that helped a lot. By no means am I a lawyer, but I have a good understanding of how to read these memos, whatever, for the SEC. It's a lot of research that gets involved. And then also, fortunately enough, our legal advisor is one of the top securities attorneys at William Mullins from their DC and Norfolk office. So really, it's just a matter of, hey, I think we can do it this way, and then taking it to our lawyer and him being like, you can do this part, but you can't do this part, and then going back and kind of reworking, revetting. Great thing is the regulations on securities, on private securities, has become more lax, and is only getting more relaxed under the current administration. So it's it's there. Regulations is a big part. It's can be expensive in some cases if done all outsourced, but it's not an impossible task by any means.
So we got a chance to touch on the real estate background, competitors, regulation, but what really prompted the development of Pocket Properties, and why did you both as co-founders decide to leverage the funder to raise a pre-seed round of capital, and even dive into the capital raising piece and some of the journey overall, right? The good with the bad.
Yeah, so I'm gonna touch on that first part. What kind of prompted us with this. So we saw really three major things when we were being young real estate investors. The first one is people don't have a lot of money. Younger people do not have a lot of money. How do we fix that to where they can invest in a cash flowing asset, but they might not have $10,000 to put down or have good credit? So we're like, how do we address that problem? The second one is knowledge. Real estate investing is a very tedious learning process. There's a lot of learning curves. It's almost as abstract as abstract math. There's a lot of unknowns, and then there's even more unknowns. And then the third thing is inventory. A lot of people don't know where to even go to find a deal. Yeah, you can check with your realtor on the MLS. That's not going to necessarily find you a good investment property. Unless you know how to turn over every rock and dive into some of these communities, RIAs, wholesalers, whatever, you're going to be looking at market rate properties all day long. So addressing those issues, we founded Pocket Properties with the goal of allowing access and democratizing access to real estate investing, and creating an ecosystem where you do not need large amounts of capital. You don't need the most real estate knowledge, and there's no tedious process. Everything's as streamlined as if you were to buy, a stock. So that's really what kind of prompted us to found Pocket Properties.
Yeah, to touch on the WeFunder portion, like the reason why we ended up going with the WeFunder campaign. I mean, being Black founders, we understand, it's there's the traditional means of raising, and we understand that. I mean, if we look at the statistics, I'm a numbers person. I mean, what 2% of capital reaches venture capital reaches Black founders. We're going to have to put up, exponentially more shots than a traditional startup. So we're looking at it. We don't necessarily care about all that. We're looking at it from a how the heck do we get to market faster standpoint. So essentially, the quickest way to make sure that we're able to raise capital.
I'll take it over. I know exactly what he's about to say. Quickest way that we saw, something that we can control. Stigmas aside, whatever. Something that we can control is marketing that we're right. Getting it in front of people's eyes, pitching it to people, instead of giving them an easy option. You froze, Chris. Sorry about that. Giving them an easy option to invest. Now, don't get me wrong. The traditional way works. Not saying that's the worst thing, but especially being Black founders, young founders, you really want to make sure you have all your bases covered. So I'm not mad if Mr. Angel over here doesn't want to give me his money, because I have planned A through Z to get to the goal that we'll say. Like Chris's favorite analogy is, we're going to build a plane. We could build a World War II plane, or we can build a Boeing. Really depends on funding. Regardless, we're going to be in the air flying. So that's really how we look at it, and how we look at the capital raise. Is it something nice to have? Yes. Is it a necessity? No, because the product will get built. We have the team to continue to build the product without outside venture funding.
This is an immense amount of perspective, and funnels rather well into the next question, which is, given that there's this initial framing of we're gonna make do with what we have. I think profit and being a sustainable business, or something that can stand on its own 2 feet, matter a lot more in these instances, and then can also draw those eyeballs in for later rounds, where those VC funders come back and say, actually, this is something that we definitely want to be a part of. So how does Pocket Properties currently make profit?
So actually right now it's we have a lot of different profit segments. So the first way that we're looking at making profit is going to be as a fund. So we're going to be flipping the first properties that we get. And it is, it's not necessarily, this is not going to be something that's user facing. This is more of an internal company thing that we're doing to get revenue on the books. So we have a $30 million approval from a private lender. That essentially we're going to go ahead and start, purchasing some properties. These properties are, 99% of them, these are going to be tokenized on our platform. But these first few ones, we are going to actually just do flips to gain some revenue. So, that kind of segues into our next profit segment, which would be the tokenization of the actual real estate assets. So that's, when we take, an investor's portfolio and we sell it on our platform, we do get a fee for doing that as well. Also, when we break down into transaction fees between the users, why am I blanking on other profit segments? Collateralized or instant lending. So that's going to be another profit segment that we're adding in, as well as banking. I'm not sure the fees that we're going to be able to collect, but ideally our white label partner will let us in on some of those, because we're going to be bringing them a boatload of users. But yeah, so as far as there's a lot of fees from the banking aspect. Stan, what am I missing? I'm missing something.
I honestly think you covered everything. All the very immediate ones.
I had a quick follow-up question on that tokenization aspect. So one common critique of crypto as it currently stands is that it's not like an exchangeable. There's no like real physical asset tied to it, right? So if you think of like Doge, for example, right? We did a very early episode on Doge, and the founder of Doge said that the reason why he created it was a running joke, right? Like, and now it's taken on this second life. But here it seems as if though the token would be tied to some real physical asset out there in the world. So is the belief that, you trade in, 5 PP coins, let's call it that for just like the lack of a better term, and you are able to like purchase a house now. So what is going to be the function of the token
So
on the
it's a
platform?
there's a little bit of a distinction between what we have and what something like Dogecoin or even Ethereum or Bitcoin has. So those are deemed currencies, right? We utilize blockchain. We do what's called a STO. And then this is all back in forward facing. Everything's referred to as shares. It's very simple, very familiar to our users. Now we're getting into some of the back end stuff with that question. On the back end, there'll be essentially a token, a share, an equity token, which is a security. So basically, if you think about it, whenever you're purchasing a stock, you are purchasing a security token. It's just a massive data that says, hey, this person hash AAA owns this much of this hash, right? So it's the same concept as if you were to purchase a stock. So it's very on a user facing aspect, it's very simple, very familiar. On the back end, we do use blockchain, and the reason for that is transparency, right? With blockchain, first off, you get quicker settlements, quicker transfer of funds. You can accept multiple payment types, and you can also track everything. Whether somebody, our users, let's say they're really into that aspect, right? They could go on there and look at how much money we've taken in from this specific asset and how much money we've issued out, and they can calculate it, and all the numbers will add up because it can't be faked, right? So there's always that open line of communication. That's the great thing about blockchain. But like I said, there's a big distinction between a currency and something like ours, which is, for a better term, it's called a security token offering, which is just a stock. It's just like if somebody IPO, they have shares, same thing.
Perfect. And why did you and Chris believe that leveraging a blockchain network, so to speak, like Algorand, would be the right fit for your startup's needs?
Speed, security, transparency. 3 major things that we're looking at. Now, when you're dealing in alternative trading systems, like ours or like Start Engine or whatever, you really want to make sure there's no double spending, that everything is tracked accordingly. You want to make sure that everybody's issued the correct documents, tax documents, 1099 Mystic or K1s, depending on whether, what the entity is. And you want to make sure you know who owns what and make sure they are a good acting character. All the anti-money laundering, all the KYC stuff. And with blockchain, a lot of that can be automated, and it, cuts down on paperwork costs, back office expenses, in some cases upwards to 60%, all the way down to a minimum of 20%. And when you're starting to do volume and have to do things like continual reporting on a security or continual cap table management, you want to automate as much of that process as possible and make sure if something does go wrong and your system goes down, that all of that is already backed up.
Okay, so essentially the company is leveraging blockchain for its benefits, for the benefits that the platform was originally spoken to. So I remember way back in 2013, way back, right? It seems so far now. That was originally why blockchain was seen as like this benefit, like, oh, there's going to be all of these distinct advantages to using the platform that just isn't going to be feasible on any other like tech stack. So it's great to see that it's going to be a very practical use of the technology.
It's kind of cool to see, touching on the blockchain a little bit, that institutions are picking it up now. JP Morgan has their own JP Morgan coin for internal fund processing. So there's a Visa has their own. Visa rail system that allows for international payment transfer and settlement within less than a minute. So it's great to see people actually picking it up as far as the utility goes.
And that's the main that's the main thing that we're kind of trying to do with pocket properties, though, is focus really on the utility of it. Because there's a lot of great stuff that blockchain can do, but right now these are all the apps and products are very niche and they're very focused on specific users. If we can translate that utility to kind of the everyday consumer, they're going to be, first and foremost, once they look at all the benefits of what it's done for them, and then somebody tells them, hey, this is powered by blockchain, they're not going to be afraid of it anymore. They're going to be fully ready to embrace it. It's really like it's like JP Morgan trying to sell electricity to people, and you got Rockefeller telling them that it starts fires and stuff. But but yeah, no, it's we just really want to focus on that utility.
Definitely understand that. And building off of that piece and taking us into an entirely new direction. Well, another question we had is, pocket property seems to be very much centered around democratizing ownership, right? So is the long-term goal to do away with outright home ownership and introduce a model wherein everyone owns fractional shares in a bunch of different homes, but are essentially perpetual renters?
Yeah, honestly, you kind of you hit the nail a little bit on the head there, just because we've noticed the way the world is kind of shifting anyway. Younger people don't necessarily own homes at the same rate as our parents do, and it's just it's a generational thing. So we do see that's the way that real estate trends are heading. Now, we are a company that we're primarily focused on wealth building for people, like helping people build generational wealth. I think that's kind of our focus, though. We are helping people build generational wealth by opening up and giving access to markets that haven't been there before. But you're exactly right, Steph. That's kind of the way we see home ownership or property ownership going in the future, is that essentially, people won't necessarily own the home that they live in, but they'll have enough invested in fractional real estate, and they'll be earning, let's say, $2,000 a month in passive rental dividends. They'll be able to pay their rent immediately and probably still have some left over. So that, you're exactly right. And then from there, people are going to get real familiar with how compound interest works, and I think it's going to result in kind of a beautiful thing, to be honest.
Could this result in free rents, right? So in a far off example, a person has 2,000 coming in from this diversified income that's paying off their rent, and then kind of like the rent question is kind of just like done away with. It's just like all cycling through the system.
And to carry a step further, we're looking at it to a place where we have users' account information as well too, so we'll know them financially better than most banks, creditors, things like that. We can get people pre-approved for housing, so it's it can be a literal sense, like this person could be a user of our platform and also literally staying in one of the properties that's traded on platform. But yeah, sorry, didn't mean to cut you off, Stan.
No, you got it. But yeah, I mean, if you look at it, it's kind of, I would say it's like the house hack. I'm not sure how familiar you guys are with house hacking, but it's like a house hack, but you might not own a house. You have to own a house to do a house hack. But and for those of you listening who don't know what a house hack is, let's say when you bought a duplex, you lived in one side, you have a mortgage on that duplex. Live in one side, you charge the person living on the other side rent. Essentially, you're living for free because they're paying your mortgage, and they might even be giving you a little bit more. But same thing is possible. Individual might be renting, but they also might have a killer portfolio. Could be grossing, $2,000, $3,000 a month, which would cover their rent. So it's another option for people to utilize. Especially when they become more savvier in the investing world. So.
The cool part about it is too, because people are basically kind of doing the people that are doing this right now, they're doing this with standard dividend stocks. And we know the returns on standard dividend stocks. They are not like that. So when we're looking at something that's 3.5 to 9% yields, and then once we ink out the finer points of our accelerated dividend program, which the back end of that involves blockchain staking, but essentially we'll be able to increase dividends by, we're anticipating, about 10%. So people are going to be earning pretty ridiculous dividends on a monthly basis. We're looking at a standpoint, somebody could basically be making, I think I'm probably close to the math on this one, but off of a $200,000-$300,000 investment, somebody's going to be, they'll be able to cover their probably cost of living for the year, as long as they're not living, crazily above their means or anything.
Yeah, absolutely. And then I want to ask this, right? Because Chris, you mentioned something interesting in that we don't own homes as our parents did in their time. And I would even take it a step further in that there's many folks who don't have parents who own homes, which is even which makes it even harder for them, or 10 times harder to kind of break into that space, because they're kind of doing it from scratch, or they don't have a good credit history, and all these barriers, right? Steph and I come from the Bronx, as you guys know. We both grew up in disenfranchised communities, so would love to hear you guys' focal point on Section 8 and low income housing initially, and how did that come about? I'm very, very curious to learn.
The focus initially was, it was dual pronged, right? I mean, we need more income-based housing. And also, when you have income-based housing, the rent is guaranteed. So it makes it attractive from an investor standpoint, but it's also attractive from a social impact standpoint. So that's our focus with providing Section 8, and looking to give those opportunities whenever possible. I mean, granted, there are some, in the city right now that we're working with, they have a large amount of Section 8 properties. So they're asking specifically that we come in and bring in some market rate properties, just because they're trying to help turn the area into the area a little bit. But there's also those circumstances where, hey, this area doesn't have much income-based housing. How can we get more income-based housing in this area? But yeah, that was kind of our focus. It was, we have to be a social, being a company in the 21st century, especially a company, post 2020, like, social impact is big. We want to make sure that we're doing good while making money. We know it's possible. And I think, I'd like to think we might be the first generation of capitalists who can all agree on that, who can say it is possible to make money and do good. But yeah, that was kind of our thought behind it.
And just to follow up, right? Because we know that oftentimes when businesses come about or initiatives are started, like especially around social impact, like initially it is for a good cause, and then somehow, some way, due to politics and other factors, it dwindles down, right? So how will you guys make sure that or try to at least prevent that the wealthy owns 90% of all or majority stocks, and that doesn't happen on the Pocket Properties app? Like how would you guys avoid that, or quote unquote the manipulation of the market, so to speak?
And just to clarify the point there, the comparison is to traditional stock market, right? So that was something that was brought up numerous times over throughout the podcast. And Robinhood was also mentioned extensively in your materials for the pitch deck. So what we've seen in the stock market is that 90% is owned by wealthy individuals, right? And the latter half is kind of split up between the rest, pensions, 401k plans, and then traditional retail investors. So how do you make sure that doesn't happen on this platform, especially considering the fact that you just made mention of things like house hacking and like this cyclical system?
Right. So kind of put that out. That's the great part about blockchain, great part about STOs. We can control how much you own or how much an individual can purchase. So, you know, we can cap you at 10%. You know, we can cap you below 10% if need be. You know, so that's how we're looking at it, is especially when it comes to some of these smaller, you know, smaller properties, smaller asset classes. 10% cap is a necessity, especially if, you know, it's a property like a small house that's $100,000. It's not hard to get in there, manipulate, do whatever you want. It's a small cap property. So, you know, there's protocols in place to stop that. Now, as far as when it starts to get to the bigger things, we're opposed to having individuals own massive amounts. Now, whether we have, like, let's say indexes or funds, like you mentioned, that come in and own large amounts of that property, that's significantly safer because there's a lot less, you know, pump and dumps or you know, transacting, because most of it is for, you know, retirement funds, pension plans. You know, a lot of them are looking for, as long as that dividend is coming in, they're going to maintain their ownership of that. So, but,
I was going to say, to be honest with you, though, I think our biggest solution to that is just going to be the 10% property cap. Because if no individual or no company can own more than 10% of each property, there's not necessarily much, like, they're going to have to either buy from, because there's protocols in place to literally prevent them from buying. They could not actively purchase more if they wanted to. But I mean, as far as to prevent 90% of, you know, the wealth being controlled by a small portion, that's going to be difficult. You know, I think we've done a good job of creating a product that's geared towards the 90%, while understanding that in order to fulfill the 90%'s demand, we have to be a company that can attract the 10% still. But, you know, doing that while, you know, without ringing the entire dinner bell and letting them know, like, hey, you know, dinner's ready. Come on, guys. You know, it's finding that sweet spot. But I think the main thing is just our initial rollouts are all going to be very, very, very 90% focused. Like our Pocket Properties premium service, which is going to be a pretty cool mixture of PropStream and TD Ameritrade Thinkorswim, combined with those Pocket Properties features. We're not planning on rolling that out until year 2 or 3, and ideally that should give the retail investors enough time to get in the door. But there's only, you know, you guys know, there's only so much that we can do. Like, we can't keep capital out. And the wealthy individuals, they need a place to park their money. So but as far as rug pulling goes and market manipulation goes, that's something that we have thought about. So that's why we do have that 10% cap protocol in there.
So you've mentioned that the properties will be focused on Section 8 and low income housing initially, and there'll also be some mixed properties in there to satisfy the needs of certain municipalities. Who will be managing the properties on the platform? Is this all going to be managed in-house, or will you leverage third-party services? And what effect will this have on resident relations, considering that, again, that target initially is going to be low-income folks, right? Is there going to be some third party that's going to say, you know, due to PP investors, you no longer have a home, right? Like, what does that look like?
It does not look like that. So essentially, we are going to have third-party managers, property managers, but we are going to have an in-house team. So that in-house resident relations team. So that's to ensure that our houses are up to standard, and these are going to be standardized standards. And I've got high standards. So they, like, our people are going to be, whatever they're content with, it's going to be a few levels above. So that's our goal there. But it will be third-party managers.
So, and to kind of answer your question about due to our investors, you no longer have a house. All the properties are managerial rights for those properties belong to Pocket Properties. So, you know, as long as the tenant, they're still under the same tenant laws, you know, as long as they're paying, they're staying, you know, and then they have the same rights and everything. So it's not like, you know, with a standard company where you can vote out a board member. The investors don't necessarily have any rights regarding tenant relations. Um,
They do have the right to collect the rent dividends though. So
they do have
that's
the right to collect the rent dividends. That is the primary thing. But as far as, them saying, hey, we don't like this tenant, he looked at me bad, like they can't do that. So the tenants have a very good protection, standard protection, um, when it comes to that.
Shifting gears a bit, I wanted to hear you guys' perspective on the future of real estate tech, right? Because it started to boom as of late. So kind of wanted to hear, where you guys are at with it. What are your thoughts? And even something as simple as REITs, right? Like, and why do REITs often get overlooked? It's clear that, it generates income, it provides dividends, right? And it also protects against inflation. So why do you guys think that REITs often get overlooked?
So I already know what Chris is gonna say, so I'm gonna address the other part. But REITs get, first off, a lot of people don't know what a REIT is. That's problem number one. Number two, REITs don't pay out that well, right? 2 to like 5%, 5% being a very, very good REIT. So I see there's an evolution of REITs and kind of how they're evolving. There's another step, and that's really going to be going into the field that we're in. Now, why do I say that? When you're dealing with a REIT, when you're dealing with a big fund, there's a lot of back table paperwork, like I discussed a little bit earlier. People have to do that paperwork. That paperwork is expensive. So with REITs giving out this low payout and they can't figure out how to get it up, it's not attractive to people. There's a way to get those dividend yields higher than 2 to 3%, by cutting some costs in specific areas. But until that's done, I think they're just going to be lingering around. REITs are a great thing. I personally, Chris hates me because I personally like REITs. They make everything, they button everything up real nice and pretty, and they're like, here you go. So I personally like REITs. Wish the dividend yield was higher. But that's why I think, that adoption, it hasn't been there. People don't necessarily feel like they're on the stock market. REITs are a very mystical thing. I know one company, Redwood Trust. I invested in them. Chris hit me up and I was like, I don't know what this is, but their patterns look good and I'm gonna go on and invest. I was like, oh, they're a REIT. I didn't know that. Is Redwood Trust. What is that? So they're not very pretty. They don't give the best yields. They can, but on this current technology that they're using, it's not going to change anytime soon.
Redwood Trust was pulling some good dividends though. That was
yeah, it was
good ones last year. But this is in no way, that was not financial advice. But but yeah, no, and just to kind of touch on just the future. I think the way future of real estate is kind of going, I think it is going towards a fractional space. I think REITs are going to become more common. I think direct ownership is going to become less common, just because it's giving people a place to park money. And I think what we're noticing is, with the rise of Robinhood, this new wave of day traders and investors. These are people who are, now they're generating money, and now their money needs places to go. So it's a cycle that's building on itself. And I think what it's going to result in is, right now, $228 trillion worth of real estate globally. And that's with only 10% of the world having access to the markets. So we're not seeing the actual value of real estate. So there's going to be another boom once fractional real estate kind of starts spinning and gets going and starts picking up more traction. But
I like to kind of add a little side to it there. When Chris is talking about, there's a big, only 10% of people are able to purchase houses, get a loan, go purchase houses. That's what we're looking at right now, right? People are already overpaying, showing that, hey, this is more valuable to me. And those are only the people who can afford to get out a loan to do, you know, to purchase the property for themselves, making that offer. So once you start opening that up to the 90% to the rest of the world, there's a lot of opportunity there.
Yeah, because what ends up happening is $100,000, or, you know, like, let's say the house, we'll say in this example, costs like $5, and we band together and we each, you know, put in our own, you know, we're the 90%, and we say, hey, this house is $5, and they're trying to buy this house for $5. You know, forget that. I got $2. George has $2. Stan has $2. Steph has $2. You know, let's get together and we'll buy it for $8. So essentially that's what we're finding, is the little guy is willing to outbid the 10% when they band together, and it's going to cause a boom, because the 10% is, they're going to have to start competing with the 90% now. So I think that's the tie-in that Stan was making there. So that's where I'm anticipating a boom down the road. It just makes sense.
And then it kind of also, I know George asked about kind of where we thought the technology, the prop tech sector was going. It's really hard to say. Clearly, everybody's starting to move to democratization. You know, there's people who see there's a hole in the market. There's a lot of people who can't afford to invest. And then I say that, you know, and it comes in all asset classes, residential, commercial, even solar fields, which is technically real estate, but it's also kind of a business. But anyway, you know, there's quite a few different asset classes that people are able to access now. But really where it's going is democratization and streamlining. There's a lot of startups that are looking at streamlining real estate processes, you know, whether that be between landlord tenants or title and lawyers, or, you know, really any step of the process. So I think the market and the prop tech sector is really moving towards simplicity rather than complexity.
Well, we covered a bunch of themes today. We covered the future of real estate tech. We covered the democratization of property investment here in the States, and given the trajectory and aims of this company, soon the globe. And we've also been able to delve into each of your backgrounds and understand how you both were able to get to this point that you are at today. And we're going to close out with one final question that provides you the opportunity to give our audience another set of knowledge, insight, and guidance. And it's, what are 3 pieces of advice each of you would give to your younger self?
Got you. Okay.
I actually had a conversation with my younger self the other day. This is it's actually funny that she did that. I don't know, 3 pieces of advice. I just have them ready to go.
I know you get nervous, Chris. I know you get nervous.
No.
My first one is continue to learn. You know, I have a whole bunch of skills, different, whether they be blue collar or white collar skills. Learn. Let's see. The second thing is, anything is really possible. But you might have to work hard for it. One thing, you know, like I said, I went to, like you mentioned, Steph, I graduated from William and Mary. Wasn't the best student coming out of high school. I was smart, I was lazy. Had to take a roundabout way to get to William and Mary, but at the end of the day, I graduated on the same day as everybody who was there 4 years. So, you know, anything's possible if you really want to work hard for it. The last thing I would say is, don't be afraid to put yourself out there. It's funny, Chris actually taught me that. He puts himself out there, sometimes all the way out there. But that was one thing that he taught me. You know, you can't be afraid to look dumb, and if you look dumb, well, you might as well ask a dumb question, or a question to get you to a better understanding of it. And that's really taken us a long way. You know, as founders is we don't know all the answers. We can project like we know all the answers, but sometimes you got to be like, hey, that was wrong, whatever, let's figure out the right one. Learning, hard work, and putting yourself out there, really 3 simple tips.
Yeah, no, those were really good ones. Stan, I was going to say that the only thing that I think the last thing that I ended up leaving with, because I was very pleased with the journey that I had, and all the jobs that I learned from, that I eventually left, and all of the lessons that I took. So I think that the one thing would just be keep going. That it's not. I don't have 3 separate pieces of advice. It's just keep swinging hammer, keep the persistence, keep learning. And make sure you ask people questions, I guess is the other thing that I would tell my younger self is network, because that is something that I learned from Stan, is the power of networking. I didn't network that much before. It definitely slowed the heck out of my growth. Probably could have gotten a lot better a lot quicker. But definitely that just perseverance, keep going, keep swinging.
Wow, this was amazing. We couldn't have asked for a better interview today. We appreciate you, Kings, for spending time with us and answering the questions we have for you and dropping gems, right? I think you guys both did a phenomenal job. And like the biggest takeaway from it all is just, to Stan's point, keep learning. No matter if you fail, no matter if you think you sound dumb, no matter if you are insecure, pick yourself up and continuously learn and be intellectually curious, because eventually you will understand that you'll pick up everything. But we hope to have you guys on future episodes. I mean, we know we will. We're not going nowhere, and I know neither you guys. So thank you again, and we look forward to it. Appreciate you.
Thank you, guys.
Thanks for having us.